In 2008, some of the biggest bank on Wall Street, companies that had survived the World War, the Great Depression, and decades of market crash, collapsed in a matter of months. Millions of people lost their homes, unemployment doubled, stock market losses to trillions of dollars in value. How did a housing problem in US turn into a worst financial crisis since the Great Depression? Today I will walk you through exactly how it happened step by step. It started with housing. In the early to mid 2008, US home prices were rising fast and everyone wanted it. Banks were eager to lend, so they relaxed their standard, handing out mortgages to people who, in normal times, wouldn't have qualified. These became known as subprime mortgages. Loan give to borrowers with weak credit or a low income, often at low teaser rate that would jump higher rate. The thinking at the time were simple. Even if this borrower struggle, home prices keep rising. So we can always resell the home for a profit. That assumption, the housing price only go up. Is the crash the entire crisis grew out of. How one risky loan become everyone's problem. Here, where it get more interesting. Bank didn't just hold onto these risky mortgages. They bundled thousands of them together in a single financial product called a mortgage-backed security (MBS). Think of it like a fruit smoothie. Instead of selling you one risky apple, they blend 1,000 loans together, some safe, some risky, and sell you a slice of the whole blend. The idea was that even if a few loans went bad, the whole bundle would have still be safe overall. These bundles were then sliced further into layers called tranches. And crucially, credit rating agencies tapped many of these tranches with top tier safe ratings like AAA. So that's the key mistake. Mortgages that were genuinely risky got repacked, resold, and mislabeled as safe investment. And pension funds, bank, and investors are all over the world brought them, believing they were solid. The housing market returns. Around 2006, US home price stopped rising and start falling. That one shift broke the whole assumption everything was built on. Suddenly, homeowners with adjustable rate mortgages saw their payment jump. Many couldn't refinance because their homes were now worth less than the loan. Defaults and foreclosure surged. And remember those safe mortgages backed securities sitting in bank portfolios worldwide. They started losing value fast because the mortgages inside them were failing. Banks that were leveraged, meaning they borrowed heavily to buy these securities, suddenly found their asset worth far less than their debts. The domino spot. This is where the crisis went from a bad year for the full blow global emergence. It's a global emergence. A key feature moment. Bear Stearns, a major investment bank, nearly collapsed in early 2008 and was sold at a fire sale price to save it from failing outright. Lehman Brothers, one of the oldest and large investment bank in United States of America, filed for bankruptcy in September 2008, the largest bankruptcy in US history at the time. This was the moment panic truly spread worldwide. And then AIG, a massive insurance company, had to bailed out by the US government because it has insured huge amount of these mortgage securities through instrument called credit default swap and couldn't cover the losses. Once Lehman fall, banks stopped trusting each other. Nobody knew who else was holding bad assets, so lending between banks, the grease that keep the entire financial system moving, frozen almost completely. From Wall Street to Main Street, once lending froze, the damage went far behind bank. Business couldn't get credit to operate, so many cut jobs or shut down. Unemployment in US roughly doubled from its pre-crisis level. Stock market around the world lost enormous amount of value. Millions of homeowners faced foreclosure. Government and the central bank stepped in with emergency measures, including large bailout programs for bank and central bank country cutting interest rate and injecting money into a financial system to try to unfreeze lending. It took years for employment, housing, and marketers to fully recover, and the crisis reshaped financial regulation for a generation, lending to new rule designed to prevent banks from taking on this kind of hidden risk again. So now let's come to a quick recap. Let's bring it together in 10 seconds. Bank handed out a risky mortgage, betting home price would keep rising. Those mortgages were bundled, mislabeled as safe and sold worldwide. When home price fell, the bundle collapsed in value. Major banks failed or nearly failed, freezing global lending. The damages spread into the real economy, jobs, business, and households. The core lesson is doesn't disappear when they repackage it and sell it to someone else. It has just become harder to sell until the moment is not. If this helped the 2008 crisis finally makes sense, let me know in the comments and tell me whether what kind of case studies we have to discuss in further videos. Thank you.